So welcome back everyone. Now this is going to be question number 40. This question might seem large to you, but it is not that difficult. So let's have a look on the question and we'll just fast forward it. The entire first paragraph is not that relevant. Just understand one thing, that I will just give you the crux of this question. We are from India and we are the manufacturer of cosmetic products. Okay, we are having the monopoly in the product, so mostly we can manipulate the buyers that we will be invoicing the particular order in Indian currency itself, just to avoid the foreign exchange fluctuation rate. So if we invoice in our own currency, then there is no fluctuation loss or profit, right? But there is a seller in the France who has objected that he need an invoice of 80 lakh French franc. So he's putting up an order, and this is a large order, but his request is to invoice the amount in the French franc. So this is going to be the first time that we will be invoicing the customer in his own currency. What does that mean? It means that we are going to now bear the risk of exchange rate fluctuation. Okay, now the delivery shall be made within 3 months. Invoice should be in the French franc. Since company is not interested in losing this contract only because of practice of invoicing in Indian rupee, they are going to just accept this order and they will invoice them in 80 like French franc. So the entire story from this to this is simple. Exporter invoice value is 80 lakhs French franc to be delivered in 3 months. That's it. Now the export manager of Mr. E, this company, export manager Mr. E approached the banker of company seeking their guidance. Because this is the first time that they are invoicing in the foreign currency, he went to the bank manager and he asked, how can we hedge the exchange rate risk? So what happened? The banker provided the following information. The spot rate is 6.60 rupees per franc. Obviously, this is not that relevant because we are not going to receive 80 lakh French franc today. It will be received after 3 months. For that purpose, forward rate is very useful for the purpose of hedging. We can just remove all the risk if we enter into a contract with the bank that we will sell all the French franc at 6.50 rupees. Okay. Interest rate in India and France is given to you. Please understand that this entire question is of 3 months. The rates are per annum. So you can just immediately convert all the rates into 3 months. So what will be that? 4.9 divided by 4 comes to 2.25%. And this will be 3. And you can clearly see that the France has a higher rate. Normally what happens is that Indian currency or Indian interest rate is higher. But in this question, it's exactly opposite. The base currency is French franc and the base currency's interest rate is high. That means French franc should depreciate or should be at a discount. So the discount in French franc should be equal to interest rate differential. Okay, let's go. Mr. E entered into a forward contract with a banker for 90 days to sell the French franc at above mentioned rate, that is 6.50. Now when the matter came for consideration before Mr. A, who is the accounts manager of the company. So this is a company, True Blue Cosmetics, and the export manager is Mr. E and the accounts manager is Mr. A. E for export, A for accounts. Okay. Then this entire matter came to Mr. A, who is the accounts manager, who might be the chartered accountant and something like this. And he approached you. You are the chartered accountant. He is just an accountant. You, as a Forex consultant of this company, is required to comment. Means after completing this chapter and becoming a chartered accountant, you have this one opportunity in your career that you can become a Forex consultant. Whether there is an arbitrage opportunity exist or not, it's very simple to find out. What we can do is we will just find out the premium or discount. We can clearly see that the French franc is at discount because it is the forward rate is 10 paisa lesser than the spot rate. So it is at discount and it should be at discount because the French franc interest rate, France's interest rate is higher. Okay, what is the interest rate differential? It's 0.75%, sir. So first of all, we will calculate the interest rate differential, which is 3 minus 2.25%, which goes to 0.75%. That means the depreciation in higher interest rate currency should be this much. And until it reaches this point, high interest rate currency should be invested. We should invest in a high interest rate currency. But if the depreciation or a discount is more than this, if the discount is more than 0.75%, then we are going to borrow high interest rate currency. So it's all about the high interest rate currency. Why? Because it is the base in this case. So let's calculate the premium or discount, forward and spot. This is the formula because we want to calculate the premium and discount in French franc, which is the base currency. You can do it in rupees also, the answer will be same. Formulas will change. So French franc, this is 6.50, 6.60 divided by 6.60, 0.10 divided by 6.60 into 100. So you can see that minus 1.5151% is the discount in French franc. The discount is more than what we had asked for. Since the French franc is carrying higher interest rate, it should be at a discount. And the discount should be limited to 0.75% if we want to invest at a higher rate, which is reasonable, or which is a rational thing to do. But you can clearly see that the discount in the French franc is higher than interest rate differential, and hence we are going to go exactly opposite. So let me just draw the timeline here to explain that to you. 0, this is a premium side, this is a discount side. The first step is to be clear about which currency you are discussing. It is the French franc which is carrying higher interest rate, and if it is carrying higher interest rate, then it should be at a discount which is equal to interest rate differential, and the interest rate differential is 0.75%. Okay, but when we actually calculated the discount in the French franc, since it was a base currency, we used this formula. We found that 6.50 minus 6.60 divided by 6.60 into 100, that's 1.5151% is the real discount. So the real discount is at this point, which is 1.5151%. And you know that high interest rate currency, we should invest in high interest rate currency if the premium or discount is in the red area, but we should do exactly opposite if it is in the green area. So what did I say? I'm just repeating it. This is an investment phase. We are going to invest here and we are going to borrow here. In which currency? The currency carrying higher interest rate, which is French franc. So we are all talking about that 12%. So what to do at 12%? We will borrow at 12% because the discount is higher than the required discount, IRD. So we will borrow French franc and invest in the rupee, and that way we can easily have some arbitrage gain. So whether there is an arbitrage opportunity, yes sir, calculate IRD, calculate the discount, and then explain that both of them are not matching and hence the arbitrage opportunity exists. Second, whether the action taken by Mr. E is correct, and if bank agrees for the negotiation of the rate, then at what forward rate company should sell the French franc. See, the action taken by Mr. E is not correct. It is not correct because of this thing. You can calculate the theoretical forward rate and you can negotiate with the bank that please fix that rate. The bank is giving only 6.5 rupees for one French franc. I am saying that they should give more, Obviously not 6.6, it should be somewhere between 6.55. 6.50 is way less. So how much we should ask the bank? It's very simple. Follow interest rate parity theory. According to that theory, you can simply calculate it as 1 plus RD divided by 1 plus RF is equal to F divided by S. Okay, rate of the domestic country is 1.0225, foreign country is 1.03 is equal to F divided by 6.6 is the spot rate. 6.6 is the spot rate. So if you will calculate F 1.0225 divided by 1.03 into 6.6, it comes to 6.5519. 6.5519, or you can just restrict yourself to 6.55. This should be the rate. Now understand, 80 lakhs French franc multiplied by 6.50 and multiplied by 6.55. There is a loss of 0.05 on every French franc. So 80 lakhs into 0.05 comes to around 4 lakh rupees. There is a loss of 4 lakh rupees if we agree with the given forward rate. We can get 4 lakh rupees more if we negotiate with the bank and fix the forward rate to 6.55. Let's have a look on the answers now. This is not required at all. Why to just mess up with the... So 6.061. This is per annum discount, sir. The discount that we calculated was 1.5151. You just multiply it with 4 and you will get 6.0604. So 6.0604 discount and 6.061 discount. That's almost same. So that's the per annum that they have calculated. Even if you have calculated this one, still the answer is correct. Since arbitrage, this is what you can change with your pattern. You can just say that interest rate differential is 0.75% and the forward discount is minus 1.515% or minus 0.75. This is for 3 months. You can present all the answers in per annum as well. So you can just deduct 12 minus 9. And you can say that since both are not matching, then the arbitrage opportunity exists. Now the decision taken by Mr. E was not correct. I knew it at the very first moment when I saw that the interest rate differential is not matching with the discount. Now if we get an opportunity, then the 6.55 should be the rate which is calculated like this. Simple. You can just follow the interest rate differential method, or 1 plus RD, 1 plus RF is equal to F by S. This is easier. The second type is easier than this. Okay, sir. And this is nothing but the forward premium or discount formula. What they did is they put this interest rate differential in the forward premium or discount formula and then calculated the theoretical forward rate. Instead of that, you can use that formula, interest rate parity theory. That's more like it's easier. The answer will be same in that. Now let's come to question number 41. See, till question number 40, you have seen lots of question for the arbitrage. I will just tell you one thing. From question number 30, you started doing the arbitrage, but you were doing the arbitrage using the cross rates. Okay. But from question number 34, you started it with the interest rate differential. That the lower interest rate or whatever the currency is, the premium or discount in that currency should match with the interest rate differential, and if it is not matching, there is an opportunity. But from question number 41 onwards, there will be a different criteria, or there will be different questions that we are going to look. So this is related to the theoretical forward rate. That is more or less interest rate parity theory, and question number 42 and 43 are almost same. I'm going to skip this question number 42. We will just take question number 43 because transaction exposure is also covered under the 43 part. Okay, let's come to question number 41 now. See, an Indian company obtains the following quotes. Spot rates are given. See, till this point, you have been doing the arbitrage with one-way quote. Bid and ask was not given to you. The calculations become, or the question becomes little difficult when the two-way quotes are given. And this is that question. Spot rate is given to you for rupees per dollar 3 months forward, and the 6 months forwards are also given to you. Okay. And you know that this is a bid rate, bank's buying rate for the asset, which is dollar in this case, base currency. So at the first rate, bank is buying the dollar, and at the second rate, bank is selling the dollar. The company need dollar funds for 6 months. Determine whether the company should borrow dollar or borrow rupees, and what are the interest rates. Okay, the interest rates given to you are like this. Interest rate for the 3 months in rupees and in dollar, for 6 months in rupees and in dollar, and all the interest rates are per annum. It's just that if you are borrowing or depositing for a shorter period, for like 3 months only, then higher interest rates are applicable. If you are doing it for 6 months, the interest rates are little lower. Also determine what should be the rate of interest. Rate of interest after 3 months to make the company indifferent between 3 months borrowing and 6 months borrowing in case of rupee and dollar. So this is where you are going to use the concept from the interest rate risk management chapter, which is forward rate, theoretical forward rates. Okay, we'll do it one by one. For the purpose of calculation, you can take the units of dollar and rupee as 100 each. Now, the very first part is, there are two parts of this question. First of all, should we borrow dollars directly or we should borrow rupees? We can take any figure because the question has not given a specific amount. We can take any figure and try borrowing both the currencies. The ultimate cash outflow after 6 months, whichever option it is going to be low, we are going to prefer that. Have a look now. See, one by one we are going to discuss this. If the company borrows in dollar, then the outflow would be as follows. See, for example, they have taken $100. So if the company borrows $100, what will happen? We have to pay the dollar interest rate for 6 months. What is the dollar interest rate for 6 months? 5.5%. So 100 multiplied by 5.5 multiplied by 1 by 2, or 12 by 6, because we have to take it for 6 months itself. So 2.75% something. Yeah. So on $100, you will have to pay interest of 2.75. Okay. So after 6 months, you will have to make the payment of $102.75. And since you have to make the payment after 6 months, you will be buying the dollars, isn't it? After 6 months, you will be repaying to the party. So you need dollar funds. You want to buy the dollar, bank wants to sell the dollar 36.40. Ask rate will be applicable. So 36.40 will be the total cost. Am I right? And the total cost in terms of Indian rupees to borrow the dollar is 3740.10. You wanted dollar fund and immediately you took the dollar borrowing itself and used it for whatever purpose. After 1 year, you have to make this much of the payment at this much of the rate, and this is your outflow. What if you borrow rupee and then convert it into dollar? So what will happen? Let's say, for example, we'll take the equivalent amount. So let's say, for example, I want to buy dollar today, right? Today I want to buy dollar. Why? I'm going to borrow rupee, and by selling that rupee, I will be buying the dollar today. Ultimately, I need a dollar funds today. I can directly borrow dollar, or I can borrow a rupee and sell it to buy the dollar. There are two options. So if I go for the second option, I will borrow rupee, sell it in the market today and buy dollar. And if I want to buy dollar, bank will sell dollar. So for $100, I will have to pay around 3610 rupees. So what I'm going to do, I will just borrow 3610 rupees. So the equivalent amount is 3610. Suppose you borrow this much of the amount in rupees, you will be paying interest at 11.5% for 6 months. That will come to 207.58. You do the calculation, 3610 into 11.5% into 6 by 12. It will come to 207.58. The total outflow will be 3,817.58 at the end of the 6 months. The amount, the outflow in this case is 37. In this case, it is 38. 3,700 or 3,800? What is your conclusion? Sir, in order to, since we need dollar funds, it's better to borrow dollar directly, not through rupees, because the rupee outflow is more in case of rupee borrowing. The rupee outflow is less in case of dollar borrowing. And the question is very simple. Since cash outflow is more in rupee borrowing, then borrowing should be made in the dollar. That's it. Simplest of the part. Now, the second part is related to your interest rate risk management chapter, where you learned about the foreign, we can say, forward rates. The question is, what should be the rate of interest after 3 months to make the company indifferent between 3-month borrowing and 6-month borrowing? It's very simple. Indifferent means the cash flows in the first option and the cash flows in the second option should be same. So let me just draw it. This is 3-month and this is 6-month. The question says that if I invest something here, I will get, let's say for example, I'm just giving an example. Let's say if I invest 100 rupees here and I'm getting 105 rupees here. Okay. Right? And if I invest 100 rupees here, I will get something here. I will invest that again at this point. And what should be the rate of interest for these 3 months so that I get 105 only at this point? The question says that we have to be indifferent in investing 2 times for 3 months, like 3 months and 3 months, or investing straight away for 6 months. We have to be indifferent. What does that mean? It means that the rate 1 plus rate of 6 month should be equal to 1 plus rate of 3 month and 1 plus rate of, we can say, forward rate of 3 month. Simple. That is what we learned in the forward rate agreement, theoretical rates. We are going to equate that and the answer will be there. We have to calculate that F 3 months. Have a look. The equation will go like this. 1 plus spot rate of 3 months, 1 plus forward rate of 3 months should be equal to, multiplied by, so 3 and 3, 6 months should be equal to 1 plus spot rate of 6 months. That's it, simple. You keep the values in this. What is the spot rate for 3 months in terms of rupees? 12%? It is 12%. For 3 months it will be 3%. See, for 3 months it will be 3%. So 12 for 3 months it will be 3%. You are going to keep it like this. This will again for 3 months and 11.5%. See, for 6 months the rate is 11.5%. So for 6 months you are going to divide it by 2. 11.5 divided by 2 comes to 5.75%. This is exactly the same equation as we used to do in the forward rate agreement. And you can calculate your interest rate after 3 months, that is 2.67%. And in case of dollar, this is in case of rupees. Same equation you are going to follow. So the rate after 3 months for 3 months is going to be 10.68% per annum for rupees and 4.93% per annum for dollar. It's the same concept, sir. Okay, let's move ahead to question number 42. Now this is based on the foreign exchange exposure. We will just talk about the foreign exchange exposure after this break and then we'll solve this question number 42 and 43. 42 will be your homework, 43 is going to be discussed in the class. So welcome back after the break. Now let's start with the chart. There are 3 types of transaction exposure. Exposure means the type of risk. Transaction exposure, translation exposure. Transaction exposure, translation exposure and economic exposure. Please understand, transaction exposure is the exposure or the risk, or we can say the probable profit or loss that can happen or that we will have to incur because of the change in exchange rate between 2 dates. Today the rate is 50 rupees per dollar. And tomorrow, let's say after 6 months, when we are about to receive the export proceeds, sales proceeds, $1 lakh, and the rate goes to 45 rupees per dollar. Today, it is 50 rupees per dollar. The day we are receiving after 6 months, the dollar, that is 45 rupees per dollar. We made the sell today, but the amount is to be received after 6 months, and the exchange rate on that date has changed. It has gone down by 5 rupees from 50 to 45. Now when we are selling that $1 lakh at the spot rate, we are receiving only 45 lakh rupees. The day we have sold some goods to the party, the invoice value was $1 lakh. If we would have received $1 lakh on the same day, we would have sold it at 50 rupees per dollar. We would have received 50 lakh rupees, and now we are getting 45 lakh rupees. There is a loss of 5 lakh rupees. Why? Because the exchange rate has changed between the two dates. And that 5 lakh rupees of the loss is called as transaction exposure. Why it is called as a transaction exposure? Because it is related to a particular transaction, first of all, and when the date of the transaction and the date of the settlement is different, and in these two dates the exchange rate has changed. It measures the effect of an exchange rate change on outstanding obligation that existed before the exchange rates changed but were settled after the exchange rate has changed. That means when the rate was 50 rupees per dollar, you started this transaction, but the rate has changed and after that you settled that transaction. So you are settling the transaction after the rates have been changed, and that's when you will call it as a transaction exposure. And it does not mean only loss. There can be gain in the transaction exposure as well. Now, what do you mean by translation exposure? Translation exposure comes without settlement. What happens is, let's say on 25th of the March, you have made some transaction, and it will be settled after 3 months. That means somewhere around April, May, June, 25th of the June. But 5 days after you have entered into a transaction, your financial year will close on 31st March. What are you going to do on the financial year ending? You are going to translate all the debtors, convert all the debtors for the closing balances, and find out profit and loss due to this translation. I think there is some accounting standard on that. So this is related to the accounting part only, not related to the SFM. So there will be hardly any question, like no questions are there on the translation exposure in the SFM. Yeah, but there are some questions on the transaction exposure. Also known as the accounting exposure. Please understand, this is also known as the accounting exposure. It refers to the gain or losses caused by the translation of foreign currency assets and liabilities into the currency of the parent company for consolidation purposes. You remember that? Translation exposure arises due to the need to translate the foreign currency assets and liabilities into the home currency assets and liabilities for the purpose of finalizing the accounts for any given period. That's it. So when we have to close the accounts, finalize the accounts, or convert it for the consolidation purpose, we convert those assets and liabilities. Assets and liabilities means they are yet to be settled. That's why they are assets and liabilities, right? And when we convert them, that whatever the gain or loss arises at that time, it is called as translation exposure. Transaction exposure, the gain or loss in the transaction exposure arises only when the settlement is done. Please understand. And what is economic exposure? Economic exposure is an overall profit or loss due to changes in the transaction dates and also changes in the demand of the product. It refers to the extent to which the economic value of the company can decline due to changes in the exchange rate. See, even if the company is losing because of the transaction exposure, even if the company is losing because of the increase or decrease in the demand of the product, the overall value of the company will decline. And that's when we are going to call it as an economic exposure. It is the overall impact of exchange rate change on the value of the firm. It's not just the transaction. It will take into account the decrease in the demand of the goods, which will also result into losses. The essence of economic exposure is that exchange rate changes significantly alter the cost of the firm's input and the prices of its output, thereby influencing its competitive position sustainability. It means the demand, increase in the demand and supply of the goods as well. So it is an overall, it considers overall impact on the company. So this economic exposure includes the profit or loss of transaction exposure as well. So this entire profit and loss is included in the economic exposure. But apart from that, the loss or gain due to increase or decrease in the demand of the products will also be considered under economic exposure. So there are three types of exposure, sir: transaction, translation, and economic. Let's have a look on the question. You will get more clarity on the transaction and economic exposure. We are not going to see any question on the translation, but transaction and economic. So this is going to be a homework question to you because this consists of transaction exposure only. And the same thing is repeated in question number 43, which consists of transaction as well as economic exposure. Have a look on this question. Messrs. Omega Electronics Limited is exporting air conditioners to Germany by importing all the components from Singapore. Now understand, we are in India, okay? We are exporting the goods or air conditioners to Germany, okay? But all the raw material which is required to manufacture that AC has been imported from Singapore. Okay, the currency of Germany is euro. So we are exporting here and we are importing from here. So practically speaking, when the cash flow will settle, we are going to receive euros and we are going to pay Singapore dollar, right? Because we are an importer. Now, the company is exporting 2400 unit at a price of euro 500 per unit. So this much of the quantity we are exporting to Germany every year, I think. The cost of imported component is Singapore dollar 800 per unit. So basically we are selling them at 500 euro and we are buying all the components at Singapore dollar 800. The fixed cost and the other variable cost per unit is 1000 and 1500. Underline the word per unit. This is per unit. Okay. The cash flows in foreign currencies are due in 6 months. Understand this one thing. The cash flows in foreign currency, that means the euro receivable and the Singapore dollar payable, both of them are due after 6 months of the transaction. The current exchange rate is as follows: rupees per euro, rupees per Singapore dollar. What is the base currency? Euro and Singapore dollar is the base currency. So whenever you will say bid is the bank's buying rate, it is the bank's buying rate for euro and this is the bank's buying rate for Singapore dollar. And then the other one will be the selling rate. After 6 months, the exchange rate turns out to be as follows. So this is today's exchange rate. This is 6 months after exchange rate. You are required to calculate the loss or gain due to transaction exposure. Let's make it very simple. Transaction exposure means what would have been the profit, because sales and purchases both are there in this question. What would have been the profit if the settlement would have done today, but in actual the settlement is being done after 6 months, then what is the profit on that date? Suppose we would have earned 10 lakh rupees if settlement would have happened today itself, and now in reality we are earning only 7 lakh rupees, let's say. So we are losing on the profit. We are earning on both the time, like on both the sides, but we are losing on the profits of 3 lakh rupees. We could have earned 10 lakhs, but we are only earning 7 lakh rupees after 6 months. So there is a transaction exposure loss of 3 lakh rupees. That is what we have to calculate. See. Question number 43. How to calculate the profit? In this question, profit is equal to, first of all, sales minus purchases, or we can say all the expenses. So let's write down sales, and everything has to be in rupees. So can I say and this is the sale, this is the profit on 1 unit. When we multiply it with 2400, we will have a profit on total units. Let's start from here. Now we have 2400 unit and we are selling every unit at 500 euros, which will be converted at this exchange rate. Am I right? Minus this is sales minus purchases, Singapore dollar 800 multiplied by the exchange rate minus 1000 rupees minus 1500 rupees. See, what is 1000 and 1500? Fixed cost is 1000, other variable cost is 1500 for every unit. Okay, so this is the purchase cost, this is the fixed cost, and this is the variable cost. All are expenses, and then you are going to deduct that from sales. Now, see, if you receive euros, euros are receivable because you are making a sale here, and the other party will pay the euros to you. You will receive the euros from the customer. You would want to sell the euros in the market to the bank. And if I want to sell the euros, bank will buy the euros. What is the bank's buying rate for euro? Euro is the base currency. Bank's buying rate will be 51.50. At the time of making payment of Singapore dollar to the other party, I will be making payment to that party, right? So I will have to first buy the Singapore dollar. And if I want to buy Singapore dollar, bank will sell Singapore dollar at this rate, ask rate, selling rate of Singapore dollar. So 51.50, can I write down? 51.50 is the euro selling rate, and 27.25 is the Singapore dollar buying rate. Let's calculate. 2400 500 into 500 into 51.50, that's 25750 minus 800 into 27.25, that's 21800 minus 1000 minus 1500. So 25750 minus 21800 minus 1000 minus 1500, that's 1450 into 2400. The total profit, if all the cash, all the receipts and payments are settled today, comes to 34,80,000 rupees. Okay, this is the profit at time t0. But you are going to repeat this since you are going to calculate the profit after 6 months. Same thing. See, this is the profit that would have happened, but it is not the exact profit to you. The exact profit that you are going to earn is this. So only the rates will change. After 6 months, what will be the rates that I am going to apply? This and this, because the quotations are same. So after 6 months, the rate turns out to be like this. If I have used 51.50 here, can I use 52 here? 52 and 27.75. 52, 27.75. So this is one thing which is happening, like, which is a good part. We are getting more sales as compared to 25,750. We are receiving 26,000 every unit, but 800 into 27.75, we are paying higher amount of purchase price, that is 22,200. 22,200 minus 1,000. So 26,000 minus 22,200 minus 1000 minus 1500 into 2400. So the real profit to us is 31 lakhs 20,000. See, the profit of 34 lakh 80,000 has decreased to 31 lakh 20,000 just because the settlements are 6 months away. So this is what we are going to calculate. Loss due to transaction exposure is 34 lakh 80,000 minus 31 lakh 20,000. So the total loss is 3 lakh 60,000. This is the transaction exposure to you. The transaction exposure can be gain also, but in this case the profit that we could have earned has been reduced. Okay, let's come to the next part now. You agree with this? Loss due to transaction exposure, profit at current exchange rate, profit after changes in the exchange rate. Now this is the loss due to transaction exposure. Now let's come to the second part. Based on the following additional information, calculate the loss or gain due to transaction and operating exposure. This operating is also called as economic exposure. If the contracted price of the air conditioner is 25,000 rupees and not euro 500. So what is the change that you are doing? Simply you are invoicing the German parties into rupees, not in euros. So you are avoiding any kind of a profit or loss on sales. On sales, you are avoiding that. But practically speaking, actually you were losing more on Singapore dollar than on sales. You can see that you were able to receive 25,750 at present rate, and you are getting more at after 6 months. So euro was not the culprit in losing money. Singapore dollar was the culprit. And that's, I don't know why they have given it like this, but whatever it is, let's remove 500 euros from the calculation and put 25,000 directly in that case. Now, but you will have to consider the new rates. Considering this, the current exchange rate changes too. Now this is going to be the new exchange rate at time 0. This is going to be the new exchange rate. You have to forget about these exchange rate. Clearly question says that the current rate has changed. So maybe after 15 minutes or 20 minutes or an hour or so, the rates has changed. So the new rates have been given to you. Price elasticity of the demand is estimated to be 1.5. We will explain this later. This will come under the operating exposure. Payments and receipts are to be settled at the end of the 6 months. This was given in the question itself. Now let's first calculate the transaction exposure in the similar manner that we have calculated. What will be the change in this? Sir, very easy to understand. Please focus on this. I will just mark it green. Instead of this part, you will straight away write 25,000 rupees because now you are not invoicing them in 500 euros. And instead of this part also, you are going to put 25,000 rupees. Okay. The exchange rate after 6 months are same, but the exchange rate at present has changed. So this one also is going to change. The Singapore dollar will be 27.15 now. Today's rate 27.15. So instead of 27.25, you are going to put 27.15. Instead of these sales, you are going to put 25,000, and rest everything is same. See, so I'm just going here. First of all, I am keeping 25,000 here and I'm putting 27.15 here instead of 27.25. Rest everything is same. Okay. And please understand, you might say that I am using negative sign and they are using positive sign. They are using positive sign because of this bracket. So they are adding all the expenses and then they are deducting it at once. What I have done is I have not put any bracket for all the expenses, and that's why I am keeping minus sign itself. Answers are same from both the angle. Okay. So you can see that profit after change. In this case, after 6 months, I'm just changing the sales. Now the new profit after 6 months will be 7,20,000, and it is 18,72,000. In the second part, the current profit is 18,72,000. Once you change the selling price from euro to rupees, your current profit is coming to 18,72,000, and the profit after 6 months will be 7,20,000. The transaction exposure, that means the loss of profit due to transaction exposure, is the difference between the two, the profit at time 0, the profit at time 6 months, and you can clearly see that the loss has increased 11,52,000. Why it has increased? I will tell you. You have changed the euro policy of export invoicing to home currency. Why? Euro was giving you a better rate and increasing the profit, and you have changed that, and that's why you have lost more money. That's what the major thing is. Now comes the better part. Are you comfortable with the transaction exposure? Transaction exposure is simple, sir. Profit at this point and profit at this point. The difference between that is the loss or gain due to transaction exposure. But now let's discuss about the operating exposure. That is going to be a fun part. See what has happened, I will tell you. This is you and this is German party. Because of the change in the policy, this German customer has to pay you 25,000 rupees. Am I right? Okay. Now you can clearly see that if this is the timeline, in our question, there are two rates for the spots given to us. And because the timing is not given exactly, we can say that in an hour, the spot rate has changed. So this is spot rate at 0 time and this is spot rate at after 1 hour, let's say. Now what has happened, because of the changes in the spot rate, the cost to the German party has changed for buying. German party is the buyer for us, and it has to pay 25,000 rupees, no matter what the exchange rates are, right? So he has to buy 25,000 rupees from the market in his country. So what happened earlier, these rates were applicable to buy the 25,000 rupees to him. Now these rates are applicable to buy the 25,000 rupees to him. So euro outflow in this case to buy the rupees and euro outflow in this case to buy the rupees is different. And because the cost has increased or decreased, he might have increased or decreased the demand as well. I will just explain that to you. Let me just first restart it. It has reached to 300 pages, man. That's why it is getting now slower. I'm afraid that I will have to use a new document. I'm trying if the same can be used. Now understand, cost of buying 25,000 rupees at old spot rate. This is the cost to the German party, right? Who is the customer? Because we are now invoicing in our currency, we have shifted the foreign currency risk to the German party. Now he has to arrange 25,000 rupees and make the payment. So cost of buying 25,000 rupees at the old spot rate and cost of buying 25,000 rupees at the new spot rate. Now we want to buy, we means the German party. Let's say we are the German party. We want to buy rupees, but the base currency is euro. We want to buy rupees, sell euro. Am I right? We want to buy rupees, that means sell euro. We want to sell euro, bank will buy euro. So which rate will be applicable? The buying rate for euro. See, at the old spot rate, the buying rate for euro is this. German party will sell rupees, buy euro, and the bank will sell euro to him. So banks okay, I am wrong in this, sorry. I'm just repeating. From the German party's angle, German party wants to buy rupees by selling euro. So German party is selling euro, bank will buy euro at the bid rate. So 51.50 is applicable. So the old spot rate of buying 25,000 rupees is 51.50. Imagine he is going to the bank in Germany and he is asking his banker to give him 25,000 rupees, and in exchange he is ready to pay euros, that is his home currency, which is going to cost euro 485.44, right? So this is the cost of buying 25,000 rupees at the old spot rate. But what happened in an hour is the exchange rate changed. So by the time he actually reached the bank to buy 25,000, the rate has changed from the old one to the new one, and in this case same bid rate will be applicable. We want to buy rupees, sell euro, and bank will buy euro at 51.75. Now the actual cost that I have to pay to buy the same amount of rupees is 483.09. You can see that savings in cost, or we can say decrease in price. Practically speaking, to the German party, one air conditioner was costing him 485.44 euros at the old spot rate, and now it is costing him only 483.09 euros. So it is costing him low, like the price to him has lowered. 485.44 minus 483.09. So we can see that the price to him has decreased by 2.35 euro. And the price elasticity has been given in the question, which is 1.5. What does that mean? If the price falls by 1.5%, the demand will go up by 1.5%. Sorry, if the price falls by 1%, the demand will go up by 1.5%. In this question, the price is going down, the demand will go up. Increase in demand. Acha, for that we have to first find out the change in the price in terms of percentage. This is the decrease in price in terms of euros, right? So let's put this here. We will calculate decrease in price in terms of percentage. So can I say 2.35 is the saving to him at the base price of 485.44. The price has decreased from this level, right? This is the level. So 2.35 divided by 485.44 into 100. So percentage decrease is 0.48%. So what will be the increase in demand? I just told you that 1% decrease in price will lead to 1.5% increase in demand. So 0.48 multiplied by 1.5, the demand will increase by 0.72%. Okay, what is the existing demand, sir? Existing demand is 2400 unit. Am I right? So increase in demand 2400 into 0.72%. Am I right? That comes to 17.28, that is 17 units. Obviously you cannot manufacture and sell 0.28 units, so there cannot be fractional air conditioner. So either you go with 17 or 18, and I think 17 is better. So what he did, because of the reduction in the prices to him, what he did is he has increased his demand by 17 units. That's a good thing for you. That's what the operating exposure is. Our operating exposure covers everything, the increase or decrease in the demand also due to change in exchange rate. You can clearly see that the spot rate in an hour has changed, and because of that the price to the German party or the customer has decreased, and because the price has decreased, he has increased the demand because of the price elasticity of 1.5. What does the price elasticity of 1.5 means? If the price is going up by 1%, the demand will go down by 1.5%, and vice versa. Okay, so the new demand is 17 units. Now how to calculate the operating exposure? It's very simple, sir. Calculate the profit at 2400 units at the current spot rate and profit at 2417 units at the ending spot rates, and that will cover both the things, transaction and operating exposure both. See, so 2417 units. Now if you will calculate 24 profit at 2417 units, the selling price will remain same, that is 25,000, and this is the settlement price after 6 months, 27.75. have a look. Yeah, after 6 months the settlement price is 27.75. okay, sir. And this is wrong. Fixed cost will not increase by 1000 in all the 17 units. Understand one thing. Okay, I'm just skipping this part and skip this one also. This is correct. If it is assumed that the fixed cost shall not be changed with change in the units, then the answer will be as follows. So 2400 units into 1000 is 24 lakh, which is the fixed cost. Please understand, just by increasing 17 units in the sales, do you think the fixed cost will change? The rent of the property, the salaries of the people are not going to change because of the increase of 17 units. You must have heard and learned about this thing in the intermediate costing subject itself. A small change in the units or production will not change the fixed cost. Let me give you an example. Suppose I have a classroom and 50 students can sit normally. I can adjust more in that also if people are ready to. But normal capacity is 50 students and I'm paying 50,000 rent of that classroom. Suppose in the next batch 5 students are the total number of students are going to 55. What I am going to do? Am I going to buy a new rent a new classroom? No, sir. I will make the arrangement for those 5 students to sit in the same classroom, and the landlord will not charge me extra rent. The rent will still be 50,000 rupees. So fixed cost never changes by a slight variation in the production. So since 2400 units was the old quantity and 2417 is the new quantity, we are not going to change the fixed cost. So what we are doing is we are just calculating the we have calculated and separated the fixed cost. We have taken the fixed cost separately, that is 24 lakh, and without the fixed cost we will calculate the profit, and then we'll put the fixed cost like this separately. So don't charge fixed cost on those 17 units. That's what we want. So what we have done is 2417 in bracket sales, this is purchase, this is variable cost, and after the bracket we have straight away taken 24 lakh, which is on 2400 unit itself. Okay, now the profit comes to 7,42,100. Understand, at this point you were selling 2400 units at 0 point, but now you will have 2417 units and the profit is 7,42,100. What was the profit when the demand was not increased? Demand was not increased and let me just, fixed cost was also same. It was, I think, 18,72,000. Am I right? See, 18,72,000. So we were earning 18,72,000 when the demand was 2,400 unit. Okay, and the exchange rate was also different. In this phase of 6 months, two things happened. First, the exchange rate changed for the Singapore dollar, and the demand also changed. So because of the increase in demand, we have certain profit, but the exchange rate is leading to loss. And ultimately, 18,72,000 minus 7,42,100 is going to the loss of 11,29,900. So this is the loss of profit due to operating exposure. Now this might be little difficult for you to understand, but let me explain that to you. It has two different parts. 11,29,900. This includes the loss and profit both. Loss and profit both. Loss due to change in exchange rate, profit due to increase in demand. So what was the earlier loss due to change in exchange rate? It was 11,52,000. Before increase in demand, the only change was the change in the exchange rate, and the loss was 11,52,000. Right? Now tell me, you have a higher demand because of the price elasticity of 17 units. You are selling all those units at 25,000. Singapore dollar 800 multiplied by 27.75 was the exchange rate. What I am doing is I am calculating the profit only on 17 units. Plus 1,500 variable cost. I need not take the fixed cost, right, for 17 units. So it comes to a profit of 22,100. So a loss of 11,52,000, profit of 22,100. Will give you 11,29,900. That's the main answer. See, now I think you are clear about it. Just this is the transaction exposure, only transaction exposure. This is the transaction exposure and this is the operating exposure. Now you know the difference between transaction exposure and operating exposure. Sir, under operating exposure, transaction exposure to included, but all the demand, profit or loss due to increase or decrease in the demand will also be included. So this is called as operating and this is called as transaction. Please remember this. This will be very easy for you to remember everything. I will just explain that here. Singapore dollar 800 into 27.75 minus 1,500, that's 22,100. So if you do the total of these two, this is loss and this is profit. If you do the total of these two, the net loss will be 11,29,900. The profit amount is very small. That's why ultimately we are coming to the loss itself. So this is operating, this is transaction exposure. Okay, sir. I think you are now very comfortable with this type of question. So we are done with, yeah, now is the time. We are done with the basic part of exposures in foreign exchange. Now, if you will revise the entire Forex, you have completed this part of basics, which we call basics: exchange rate, base currency, counter currency, bid and ask, direct, indirect, spot forward, spread and swap, American, European, then cross rates, premium discount. We are going to discuss this, like this is a theory part, you can just go through it. Pips, merchant rate, interbank rate we have discussed, broken period forward rate we have discussed about the interest rate parity theory, interest rate differential, arbitrage using IRPT, purchasing power parity theory. We are yet to discuss this is covered under international financial management chapter. Then we discussed about the exposures in the forex, that is transaction, translation, economic exposure, right? Now we are going to move over to the last part of our chapter. Last part doesn't mean that we are about to finish the chapter. No, sir. This is going to cover lots of questions. We are going to hedge the foreign exchange exposure, risk management in a forex. See, there are lots of chapter where we manage the risk as well. Derivatives, portfolio, risk management chapter itself, interest rate risk management, foreign exchange and risk management. So international financial management. Management is a common word in our SFM. Okay, so decision, we are going to do the hedging. For the risk that is there in the forex, we are going to take some decision whether to excuse me, whether to keep the position open, that means not to hedge. If we are not hedging, that means we are going to convert all the payable and receivable at the spot rate of that date. But we can avoid the risk by hedging, and there are two ways of hedging: internal methods and external methods. Internal methods means the company will do some will change some policies, will do something internally without taking the help of the other organization. So first approach is home currency invoicing, that we have just discussed in the previous question, when the company changed the foreign currency invoicing from euro 500 to 25,000 rupees. That means they have avoided the exchange rate fluctuation of euro. So all the risk that could have been because of the change in the euro exchange rate was avoided by us just by changing the invoicing to home currency. Then there will be some questions related to leading and lagging, netting, matching, price variation. No questions on asset and liability management. More of it you are going to see under the external hedging. External means you are going to take the help of the other organization. Other organization can be bank, exchange as well. So derivatives, there are two parts for the external hedging. First is the derivative, second is the money market hedge. In the money market hedge, you are going to take the help of banks. But in derivatives, you are going to solve the questions related to forward, option, futures and swaps. That's it. This is what you are going to discuss now. So we are going to start the questions on hedging. This is a theoretical question, question number 44. Just a basic question. You can also skip it if you want. It was there in the old syllabus practice manual. So if you are short of time, I will request you also to skip this question. I'm not taking all the small questions because all these will be covered in the later questions when we are going to actually do something. You remember there is one question related to rice trader in derivatives, commodity derivatives. It is just like that. I'm keeping it homework. Don't do it right now. Let me complete the derivatives part of the forex, and then you can do it by yourself if you want. And this is very similar to that question of derivatives, rice trader. So welcome back everyone. After this break, we are going to start with the foreign exchange risk management part. And under that risk management part, we are going to discuss how we can hedge the exposure that we have. Most of the questions will be from the point of view of either the exporter or the importer. Understand that exporter would want to sell the foreign currency because he will receive it from the customer. He would want to sell the foreign currency, and the importer would want to buy the foreign currency because he has to make the payment to the customer, or sorry, the other party, vendor. But no matter which currency you want to buy or sell, what matters the most is the underlying asset or the base currency of the quote before picking up the bid or ask rate. So whenever you will go to the bank to buy something, please make sure that you are putting a requirement in the base currency. Have a look on this question. The following two-way quotes appear in the foreign exchange market. The spot rate and 2-month forward rate is given to you. And the very first thing that we should discuss is the base currency. This is clear from the entire transaction or the quotations that the base currency is dollar. Okay. So at bid rate, bank is buying the dollar. At ask rate, bank is selling the dollar. How many dollars should a firm sell to get 25 lakh rupees after a month? We will discuss in terms of the dollars. We want to sell the dollars. That means bank will buy, and that too after 2 months. Bank will buy at this rate. Simple. After 2 months, bank will buy, we will sell 47. Since you can clearly see that 25 is lakhs is also rupees, 47 is also rupees. Both the currencies are same. That's why we are dividing. Okay, clear? This much of the dollars are required to sell in order to purchase 25 lakh rupees. Okay, how many rupees is the firm required to pay to obtain? Obtain means buy 2 lakhs dollar in the spot. So we want to buy the dollar. Think from the base currencies angle. Forget about the rupee requirement. We want to buy the dollar at spot. Bank will sell it at spot 46.25. Multiply straight away. 2 lakhs multiplied by 46.25. I will just make some correction of that space in 2 and the zeros. Assume the firm has $69,000 in the current account, earning no interest. That means if you keep those $69,000 in the current account, you will not earn any kind of interest. It's not a savings account, it's a current account. Return on investment on rupee investment is 10% per annum. You can clearly see ROI on rupee investment is 10% per annum. So if you convert that $69,000 to rupees today, you'd withdraw that $69,000, sell that $69,000, bank will buy it today at this price. You will sell it, bank will buy it at this price. So you will get the rupees, you can invest that at 10% per annum. Should the firm encash the dollar now or 2 months later? So there is a situation in front of you. I will just show you. You have $69,000 in your bank account. Okay. If you encash the dollars now, what will happen? You will sell the dollar. You will sell $69,000. Bank will buy it at spot, and the spot rate of bank's dollar buying rate is 46. So how much rupees you will receive from the bank? Today you will receive around 31,74,000. What are you going to do? You will invest it for 2 months, right? So you will earn interest on that. How much? 31,74,000 into 10% into 2 by 12. You will get 52,900 along with the principal amount. The total that you will receive is 32,26,900 in terms of rupees. So this is what will be the cash inflow at after 2 months. This is one option, that you can sell dollar, buy rupee, invest rupee, and receive the rupee along with interest. Do you get that? Let me just show you once again the cash flows. I will take this part a little to this space. See, The first situation is sell dollar today. You will buy rupees, invest that rupees and get that rupees along with the interest after 2 months. This is coming to 32,26,900. The other option is keep the $69,000 in the current account and directly sell that 69,000 on this date at a forward rate. So if you will sell that $69,000 at a forward rate, bank will buy it at 47 rupees. You will sell it, bank will buy the dollars. The buying rate for the dollar of the bank is 47. So what will happen in the second case? Encash dollar after 2 months. So sell $69,000 at 47. Simple, nothing else is required now. You will receive 32,43,000. Now you choose which option do you want. If you will sell $69,000 directly here instead of here, okay, at 47 you will get 32,43,000. So our suggestion will be to go with this. Sell the dollar after 2 months only at a forward rate because we are getting more amount in that. That's the end of the story. 3243. It is better to encash the proceeds only after 2 months and get the opportunity gain of 32,43,000. Let's have a look on this question. I think this is related to forward futures. No, this is related to when we should invest. Question number 48. AMK Limited is an Indian based company, has a subsidiary in US and UK. Just imagine, Indian company has 2 subsidiaries in America and in UK. Forecast of the surplus fund for the next 30 days. For the next 30 days, there will be some surplus and deficit at all the 3 centers, India, US and UK. Okay, are as follows. In US, we have $12.5 million surplus. That means there is no use of this much of the funds that we have for the next 30 days. And in UK, we have £6 million. Foreign exchange rate information is also available. You can clearly say that you are an Indian company. Your home currency is rupees and rupees is the base currency here. That means these quotes are indirect because the quotations are foreign currency per unit of home currency. Just a second. So you should be very careful while using the rates. That's it. We don't have to convert these rates. Please do not make this mistake of converting all the rates into rupees per dollar and rupees per pound so that the rest of the calculations gets easy to you. What will happen is that you will end up making a rounding of mistakes in all the calculations if you start with this reversing thing. So never do that. I think till now I have not asked you, instead of the cross rate, except for the cross rate, I have not asked you to convert the direct quote to indirect quote in any of the questions except for the cross rates requirement. So never do that. As much as possible you should keep it as it is. Annual borrowing and deposit rates are available. See, if you want to borrowing from the bank or no, this is clear meaning bank will always borrow at a lower rate. So if we want to deposit, bank will borrow. So this is from our angle. We can clearly see our angle. We want to deposit, bank will borrow at 6.2. But if we want to borrow, bank will lend us at 6.4. Obviously, think from the bank's angle. Bank will never make a loss. They will lend you at a higher rate and they will take the deposit from you at a savings from you at a lower rate. So this is from our angle, borrowing and deposit. If you say this is borrowing, this is deposit, this is from our angle. And if you want to discuss from the bank's angle, this is the deposit rate and this is the borrowing rate. So bank's borrowing rate will be always lower. Okay. So the question is very easy, don't get confused. These are the rates from our angle. We will always borrow at a higher rate from the bank, and the higher rates are given in the first place. Indian operation is forecasting a deficit of $500 million. So in India, there will be a deficit, not surplus, for the next 30 days. It is assumed that the interest rates are based on the 360 days. So do not take 365 in the calculation. The institute has given a good suggestion that you can make the calculations very simple, 30 by 360. Calculate the cash balance at the end of 30 days period in rupees for each company under each of the following scenario, ignoring transaction cost and taxes. So for all the companies, we have to find out what are the cash balances at the end of 30 days, and all should be in rupees. That means we have to convert all the foreign currency cash flows in rupees after 6 months or 30 days. So after 30 days means we have this rates. What does that mean? It means that UK subsidiary will invest 6 million pound in its own country. They will gather interest on this, and after 30 days, whatever will be the pound receivable, that will be sold, or that will be converted, not sold, converted at this rate of 0.0150, so that we will get to know the rupee value of principal and interest. Same we are going to do with the dollar surplus. We are going to invest $12.5 million in US itself. We will add interest in terms of dollar, and the total dollar will be then converted at 0.0217. And 500 million to already is in rupees. You just have to make sure that you are paying interest on that because of the deficit. We are not going to receive. On surplus, we will receive interest. On deficit, we will pay interest, assuming that we are going to borrow this much of the amount. Okay, sir. There are two options given to you in the question. One is to invest. This is question number. Okay, I will just directly take it from the question itself because of the simplicity. Question number 48, right? See, acting independently means every party or subsidiary is investing in their own country, and at the end we are going to convert that amount in rupees. So let's have a look. So from the very beginning, I think they are converting. No. See, the format by the institute is not proper. I think they should have clearly mentioned few things. See, it has to be done like this. Question number 48. Invest in respective, or we can say invest or borrow in respective country. So what will happen? Just have a look. Currency, we will write surplus or deficit. Then interest rate applicable, interest amount for 30 days, okay, total in foreign currency, exchange rate, we are going to convert that, and total in rupees. Am I right? This is how we are going to go. So US dollar, UK pound, and Indian rupees. Okay, so we have $12.5 million. Everything is in million. Okay, make sure you know, keep a note of that. 6 and 500 in bracket because it is deficit. Now, what are the interest rates available? We want to deposit $12.5 million. So the deposit rate for the dollar and pound will be applicable. Our deposit rate is the second one. So 1.5 and 3.7%. Am I right? because we are going to deposit or invest that amount, bank will always give us less interest. So that is 1.5 and 3.7. Dollar and pound. This is percentage. So let's calculate 12.5 into 1.5% into 30 divided by 360. So I'm just calculating it for 1 month. 15625. And the total will be plus 12.5. That's 12.1. Yeah, 12.5156. I'm just restricting it to 4 decimals. Then 6 million pound into 3.7% into 30 by 360. The interest amount comes to 0.0185, and add the principal back to it, it will be 6.0185. Let's focus on the Indian rupees. We have a deficit in Indian rupees, and we will be borrowing the Indian rupees at 6.4%. The borrowing rate for us, bank will always charge high. So 6.4% is applicable to us. 500 into 6.4% into 30 by 360 will give you 2.667. 4 decimal, na? 6667. So it will be 502.6667 in terms of rupees itself. Now, since all these cash flows are at the end of 30 days, right? Do you agree with this? So we will convert these cash flows into rupees at the 30 days rate. What are the exchange rate after 30 days? 0.0217 for dollar, 0.0510, 0.0150, not 51, it's 150, and rupees to rupees. We will keep 1 for that. See, this is in dollar, 0.0217 dollar per rupee. This is also dollar. Both the currencies are in dollar. We are going to divide it. Don't make a mistake of multiplying it. So 12.5156 divided by 0.0217, we will receive 576.76. 576.76 millions. 401.23 and 502.66, or we can just round it off to this in bracket, because it is deficit. This is deficit, so we will have to pay. The total will be this much. $475.32 millions. At the end of 30 days, we will have the total of 475.32. Is it matching with the answers given by the institute? See, 475.32. This is in thousand. Never do this. If the question has given you the figures in millions, use the same format for the answer. Don't do this mistake of writing by your own. So this should be 475.32, exactly matching. So the answer is okay by the institute, but the presentation could have been better. They could have written that this is the exchange rate, this is the interest rate applicable, and the total is this much, and then we are converting and making the total. Now the last part. So this was the first part. Each company invests and finances its own cash balances or deficits in the local currency independently. That's what we did. Now cash balances are pulled immediately to India. Today itself, all the cash balances, whether it is foreign currency or home currency, pull it in India, convert that in rupees today itself. So if you convert that in rupees, what will happen? Today's exchange rate will be applicable. And then you can net off all the three values in rupees and invest if there is a surplus, borrow if there is a deficit, a single Indian rupee. So let me just clear it to you. This is an easy part from the calculations point of view. See, US dollar 12.5 spot rate. This is surplus. What is the spot rate for dollar? 0.0215, right? So this is going to be the surplus of US dollar in terms of rupees. Now UK pound 6.0149 is the spot rate. Today itself you are converting these cash flows, these surplus into Indian currency. So 12.5 divided by 0.0215 comes to 581.40, and 6 divided by 0.0149 comes to 402.68. The total is 984.08 less India's deficit 500, right? Both of these are surpluses. India's deficit is this much. 484.08 is the surplus left after adjustment of everything invested. We are going to invest that surplus, which is in terms of rupees, and we will get a rupee interest on that. Interest at what rate? We want to invest in rupee, that is deposit rate, which is 6.2%. 6.2%. So 6.2%. Let's calculate. 484.08 into 6.2% into 30 divided by 360. Everything is for 30 days. So 2.50. Now you can see 484.08 plus 2.50 comes to 486.58. That's the cash balance at the end of 30 days. Now you decide which one you will follow. Obviously, we will follow this procedure because it is giving us more cash flows at the end of 30 days than this process. So instead of allowing every subsidiary to invest in their own country, let's ask them to immediately send all the surpluses to India. We will convert them at spot rate, adjust the India's deficit, and the balance will be in rupees invested in India for 30 days, on which we will get 6.2% interest, and still we will have more cash flows at the end of 30 days as compared to the first option. Getting it? Question is also asking you, which method do you think is preferable from the parent company's point of view? Sir, where is that answer? Immediate cash pooling is preferable as it maximizes interest earning. 484.08. Let's see. 486.58. Let me. Acha. This 484.08 has already been achieved at this stage. Before investment. 484.08. So, before investing itself, the cash flow was higher than what was there in the first option after 30 days of investment. So forget about the interest rate. Whatever you are going to add, that is going to, like whatever you are going to earn, that is going to add the value itself, increase the value. So the decision can be taken at this point itself before investment. So that's what the institute has done. They have not showed the interest there. But according to me, the calculation should be made on the basis of 30 days itself. But that's okay. 2501 will accrue. If the company decides to invest pooled amount. Yeah, so there is a problem in the institute's answer with this. All these figures are in thousand. So this 484,080 is also 1000, and this 2501 is also 1000. So this is practically 2.50 that I have written in my calculation. Do you understand that? Please follow the method or the same format which the institute is asking you in the question. This is the institute's answer itself. You can cross check it from the RTP November 15 and you will find the same answer. The answer is right, but the format is little clungy. Okay. Question number 49. Question number 49 and question number 50 are same. So question number 50 you are going to take as homework. Let's discuss this question number 49. Interesting calculations are there. KGF Bank's Sydney branch has a surplus fund of $7 lakh. Sydney is in Australia. Okay, please understand that. So the currency is Australian dollar. Now, how much surplus do we have? We have $7 lakh of the surplus for a period of 2 months. Cost of the funds to the bank is 6% per annum. What does that mean? We might have borrowed, say, I'm just assuming, let's say, uh, 10 lakhs, yeah, 10 lakh dollars, and 3 lakhs out of that has been put to use. I'm just telling you or framing the story behind this statement. So that has been put to use, and balance 7 lakh dollar is surplus for the next 2 months. We will have to pay interest on this surplus even if we are not using it. See, it's very simple. Lot of student gets confused that the surplus word is written here and still the question is saying that we are paying the cost on that surplus amount. How is that possible? So this is the story that I have framed. Assume that the Sydney's bank, Sydney's KGF Bank Sydney's branch had borrowed 10 lakh dollars, and out of that 3 lakh dollar might have been put to use, like might be used, but 7 lakh dollar is something which can only be used after 2 months. So for the next 2 months this amount will be lying in my bank account idle, and because the bank who lent me 10 lakh dollars has nothing to do whether I am using that money or not, they will charge me the interest on that. And that's what the question is saying, that we will have to pay an interest of 6% per annum on this 7 lakh dollar as well. Forget about the 3 lakh dollar. Don't ask me questions about what is going to happen, or the interest has to be paid on the 3 lakh dollar as well. This is the story that I cooked up. Ultimately I had to reach at 7 lakh dollars. So you can take 13 lakh and 6 lakhs as well. So on 7 lakh dollar we will have to pay 6% interest for sure, no matter what you do with that amount. And 6% is per annum. How much for 2 months? It's very simple. 7 lakh into 6% into 2 by 12. 7 lakh into 6% into 2 by 12. That goes to 7,000. That is, at the end of 2 months, we will be paying 7 lakh 7,000. 7 lakh $7,000, and we are in Australia. We have to make a payment of US dollar. Just imagine, at the end of 2 months, what are you going to do? You will buy the US dollars and then make the payment. So how much Australian dollar you will have to pay in order to buy the US dollar after 2 months? Because that is for sure. So we'll take that rate. Sydney on New York. Sydney means Australian dollar, New York means US dollar. And this is somehow little difficult to understand, that which currency is home currency and which currency is foreign, or we can say which currency is base currency and which currency is counter currency. It is very clear from this rate now. Australian dollar, and Japanese yen is the Tokyo. Tokyo is in Japan. So Japanese yen. Now you tell me, 79 is written here. So 79 are the Australian dollar for one Japanese yen or Japanese yen for one Australian dollar? Sir, it is Japanese yen for one Australian dollar. So in both the cases, we will apply the same logic and Australian dollar will become the base currency. This is the price, the currency, this is the price currency. Automatically. This is how you have to pick the rates. That's cool. Now understand one thing. We have to do all the transactions for 2 months. So I think we do not require the 1 month swap points. But we need 2 months swap points, right? So in advance itself, we can calculate this. The swap points for the 2 months are given and the swap points are in ascending order. Can you clearly see that? 25 by 30. That means in order to calculate the forward rate of 2 months, we can add those points at the end, not the beginning, at the end. So let me just get ready. Forward rate. So this is US. I will just write it. Australian dollar USD. Spot rate is 0.7100, 0.7300. Swap points are 0.0025, 0.0030, and the forward rate will be for 2 months 0.7125 and 0.7330. Okay, you have reached at this stage. This is very useful. We will put to use it. And then Australian dollar, Japanese yen. The spot rates are 79.0900 and 79.2000. The swap points for 2 months, can you clearly see these are in descending order? You have to be very careful in this case. These are in descending order. We are going to deduct that if you remember the concept of swap point. So 0.0055, 0.0050. So this will be 79.0845 and this will be 79.1950. Right. So these are the rates. Now, coming back to the topic, you have to pay 6% interest on the US dollar borrowings. That comes to 7,000. So at the end of 2 months, you will be paying $7,07,000 to the party. So for that purpose, you need to buy the dollars, US dollar. But please understand, in both the cases, Australian dollar is the base currency. And the rate that we have to pick from is the Australian, this one, right? So put the requirement in terms of base currency. Understand once again now. We have to buy US dollar. That means we would be selling Australian dollar, the base currency. And if we are selling Australian dollar, the bank is buying Australian dollar after 2 months. The buying rate of Australian dollar is bid. So which rate will be applicable? Sir, this rate will be applicable. Am I right? This is how you have to be careful. If you just blindly interpret that I want to buy the dollars, bank will sell the dollars and hence apply the ask rate, wrong. Because you want to buy US dollar and bank is buying and selling Australian dollar in that quote. That's where everything is going wrong. You are not looking at the product of the bank. You should put requirement in Australian dollar throughout the question before picking the rate. Don't talk to me about Japanese yen and US dollar. If you have to, convert the requirement in Australian dollar, because that is the base currency. Okay, once again, we have to buy this US dollar. That means we will be selling Australian dollar. Bank will be buying Australian dollar, hence bid rate 0.7125. Now understand, this is US dollar per Australian dollar. So the value, the currency of this number is US dollar. The currency of 7,07,000 is also US dollar. Both are same. That means we are going to divide 0.7125. 0.7125. This will give you an answer that how much Australian dollar will have to be paid in order to buy 7,07,000 US dollar. So you will have to pay Australian dollar 992281 at the end of 2 months. Okay, but this is the story at the end of 2 months. You should know one thing, that you have 2 months where you can utilize this money. Okay, let's read the question further. They propose to invest these funds in Sydney, New York, or Tokyo. If we invest that in Sydney, just understand that we will have to convert the US dollar into Australian dollar, because the currency of Sydney is Australian dollar. But if we invest in New York, the currency of New York is USD. We don't have to convert because we already have $7 lakh with us. So let me just write down, the currency is Australian dollar and we have USD. We will have to convert. Here the currency is USD itself. We also have USD. No need to convert. And the currency here is Japanese yen, right? And we have USD. We will have to convert. But please understand, there is no exchange rate given directly in the question for US dollar conversion to Japanese yen. Either it is Japanese yen with Australian dollar or it is USD with Australian dollar. So you will have to calculate the cross rates as well in this question, so that you can transfer this US dollar to Japanese yen using the cross rate. Okay, we'll do that and obtain the best yield without any exchange risk to the bank. The following rates without any exchange risk means wherever possible you will take the forward rates, forward contract. The following rates of interests are available at the 3 centers for investment of domestic funds there for a period of 2 months. That means in Sydney, if you invest Australian dollar, you will be receiving 7.5% per annum. These are investment rates, sir, not the borrowing one. In New York, if you will invest US dollar, you will get 8% per annum. And in Tokyo, if you will invest Japanese yen, you will get 4% per annum. Okay. The market rates in Australia for dollar and yen are as follows. So in Australia, the dollar values are given. In Australia, the Japanese yen are given. In both the cases, Australian dollar is the base currency. At which center will the investment be made and what will be the net gain to the bank on the invested fund? You have this 2 months. And you know one thing for sure. Whether you invest this amount or not, at the end of the 2 month, since you are from Sydney, your outflow has to be calculated in outflow or inflow has to be calculated in Australian dollar. You will have to make a payment of 992.81 Australian dollar. Why? Because with this amount of 992.81, you will buy US dollar of 7,07,000 so that you can repay this amount. Okay. So this is the cost which is fixed. What you can do is you can invest this amount for 2 months and then get back it into Australian dollar. Convert the end value in Australian dollar. You might gain something. Let's first invest this amount in Sydney itself, where we can earn 7.5%. So what is going to happen? Just understand, it is going to take time. But this is a very good question which will cover lots of concept: bid, ask, direct to indirect conversion, cross rates as well, deposit, interest, and maximum things are being covered. Question number 49. First, invest USD 7 lakh in Sydney. Okay. Am I right with the spelling? NEY, right? Okay. So let's just plan out what will happen. We have US dollar with us, right? We can sell those US dollar today to buy Australian dollar and then invest that Australian dollar to receive Australian dollar along with interest, right? This Australian dollar, and then use this Australian dollar to make the payment of 992281. Why? I will just show you. 992281 to buy USD 7,07,000 so that you can repay that 7,07,000. So this will automatically get cancelled because you will be buying $7,07,000 and making a repayment along with interest. So the difference left between this and this will be your profit and loss. So if you will remember this, I am removing this part because this is not relevant. You should remember that why I have taken this 992281 to repay the dollar borrowings, US dollar borrowing. This is for sure gonna come even if you are not going to do these activities. Okay. So can we do it now? Okay. We want to sell dollar at spot, but dollar is not, US dollar is not the base currency. Australian dollar is the base currency. So if Australian dollar is the base currency, we want to buy it by selling the US dollar. We want to buy Australian dollar. That means bank will sell it. Ask rate. Spot ask rate. Can I use this one? No, sir. This is forward rate. We are selling the US dollar and buying Australian dollar at spot. So we will have to use this one. Am I right? This is the bank's selling rate for Australian dollar. Bank is selling Australian dollar. We are buying Australian dollar by paying this. Okay. So what will happen? What I can do is see all the calculations are given here. So I'm not putting a format. I'm just giving you a rough working for this so that you understand the calculation. I will be selling $7 lakh here and at a rate of which rate? 0.7300. This is also dollar, US dollar per Australian dollar. So same currency. 0.7300 I will buy Australian dollar. So 7 lakh divided by 0.73. How much? 958904. This much of the Australian dollar will be received by me today and I will immediately invest the same. I will immediately invest the same. Now what will happen? I will also take the forward contract for this particular transaction. I will show it to you later. Now I will receive interest on this for 2 months at a rate of 7.5% per annum. So how much will be the interest? 7.5% into 2 by 12. The interest amount will be 11986.30. So Australian dollar 11986.30. So we can just close that. Is the institute taking decimals? No. So 11986. So this is what you invested. This is what you earned on that. The total of the two will be received by you. 958,904 plus 11,986. See how much you are going to receive at the end. 970,890. 970,890. This is it. You sold this much, received, invested, earned interest, received this value at the end and paid this much to repay the dollars, and you can see there is a loss, minus 992281. Instead of having a loss, like 21391 Australian dollar. So we have a loss of Australian dollar 21391 total loss. So this is what is going to happen if you invest that amount in Sydney. Okay. Let's try it in New York. The good part in the New York is the currency is same. See, you have US dollars. What are you going to do? You will straight away invest US dollar in the New York, because the currency which is required to be invested in New York is the same that you have. So you will invest 7 lakh dollars in New York to earn around 8%. So how much are you going to receive? 8% into 2 by 12. 7 lakh into 8% into 2 by 12 plus. So this is what you are going to receive, 9333. So that means 7,09,333. This is the US dollar. And how much you have to pay? What are you going to do now? Don't write Australian dollar, because you are bringing the money from US dollar, and you know that you have to make a repayment of the US dollar itself in America. So what are you going to do? You will repay out of that amount itself. You will repay 7,07,000. Don't bring 7,09,333 US dollar in Australia, convert that in Australian dollar, and then separately buy 7,07,000 same US dollar and make the payment in New York. Still, you will have to make a payment of 7,07,000 in New York on one side, and you know that we are bringing 7,09,300 from the same city in the same currency. So the very first thing that a rational person will do is, out of that amount, you repay in the same city itself. Don't put a pressure of converting anything. So forget about this type of conversion. This type of conversion in when you are investing in New York, because the currency is same. Directly pay 7,07,000 there itself out of the investment that you have received. So out of 709,333, you are going to pay 707,000. And the balance dollars left with you, that is 2333, will be brought to the country Australia, and you will now, at this date, after 2 months, you will sell US dollar. You have this much of the surplus gain. You want to sell US dollar, but base currency is Australian dollar. Please remember that all the time. Whenever you are picking up a rate, talk to the bank in terms of the product. You want to sell US dollar, buy Australian dollar. That means bank will sell Australian dollar at the end of 2 months. So bank's selling rate for Australian dollar at the end of 2 months is this. Am I right? This is the ask rate for bank is selling Australian dollar at this, and we need Australian dollar by selling USD. So the rate applicable here is 0.7330. This is your gain, 2333. So 3183. This is your gain. So out of Sydney and New York, it is better to invest that US dollar in New York, because we have some profit in this case. There is a loss in Sydney. Now, the third and the most difficult part of this question, if you want to invest in Japan. See, you have US dollar, and what you can do is you can sell US dollar, buy Australian dollar with that. You cannot buy Japanese yen because the rate is not available. So practically what will happen, you will sell US dollar in your own country at spot, buy Australian dollar, and then sell this Australian dollar to buy Japanese yen. This is called as cross rate. You can directly calculate the cross rate with the help of this. and then put the money to investment. Since you have bought Japanese yen in your own country, you are going to invest this Japanese yen in Japan. Understand the procedure. You have the dollars, you will sell it first in Australia, receive Australian dollar, sell those Australian dollar and receive Japanese yen, invest that Japanese yen. And after 2 months, what will happen? See, you will receive interest along with the principal amount. Along with this principal, you will receive interest. So you will receive Japanese yen. What are you going to do with that? You will sell those Japanese yen and receive Australian dollar, because your own currency is Australian dollar. That's it. And out of those Australian dollar that you have received, you will pay Australian dollar how much? 992281. 992281 in order to make the repayment of borrowing that you had made. You will have to make a repayment. We are making a repayment at every stage. In Sydney, we paid this much 992281 to buy $7,07,000 and make the payment. In New York, we directly made the payment of $7,07,000, and in this case also we are buying $7,07,000 from our own country. So we will be bringing Japanese yen from Japan, sell it in Australia, and receive Australian dollar. Out of that Australian dollar that you have received, sell 992281 and receive 7,07,000 US dollar and make the payment to the party. The balance left between the last two Australian dollar will be your gain. Now let's start. 7 lakh US dollar. You want to sell it today and receive Australian dollar. I think the same thing we did here. So the rate applicable is 0.73, and this is what we are going to receive, 958,904. Have a look. 0.73, 958,904. And immediately you will sell those Australian dollar. You want to sell Australian dollar, bank will buy Australian dollar. Australian dollar is the currency, base currency. You want to sell Australian dollar. In case of buying the Japanese yen, bank will buy Australian dollar at spot. Which rate is applicable out of this? Bank will buy Australian dollar at spot, 79.09. So the rate applicable is 79.09. Understand, this is Australian dollar, this is Japanese yen. Both the currencies are opposite. We will multiply it. So 958,904 into 79.09. So the Japanese yen that we are going to receive is 7583,9717. Around 7 crore 58 lakh 39,000 Japanese yen. And the same will be invested in Japan. How much interest we are going to earn on that? Let's find out. We are going to earn 4% per annum. So the calculation will be 4% into 2 by 12. 50, 55, 98. This is the interest that you are going to 55, 98. Am I right? So along with this principal and this interest, you will receive the investment proceed at the end. 75839717 plus 50 55 98 7634 5315. This is what you have received at the end of 2 months. Same will be sold by you at forward rate, because you want to buy Australian dollar. Your own currency is Australian dollar. You want to buy Australian dollar at the end of 2 months. Bank will sell it. At the end of 2 months, you want to buy Australian dollar. Bank will sell it. Am I right? 79.1950. Understand, these are Japanese yen per Australian dollar. These are also Japanese yen. Currency is same. Divide it. So 964,017 This is what you are going to receive. Out of that, you have to pay 992. That means there is a loss of 28,264 Australian dollar. 28,264 Australian dollar. I think, is it 28,000? There might be some calculation mistake, but all in all, this is it. We'll just check the calculations and you can see, let me just check the calculations first. Arbitrage loss of Australian dollar 21,391. 21,391. Second. On the next page. Gain of Australian dollar 3183. Gain 3183. Lastly, arbitrage loss of 30,352 and we have 28,000. So let me check. I think we have made a mistake at some or the other point, or this might be due to rounding up. Yeah, this can be the result of the rounding out, but let's check. 2000 is a big figure. I will check the exchange rate. 0.73, 79.09. See, 79.09, 0.73. Both of them are correct. And then 79.1950 is also correct. 79.1950 is also correct. Let me check the Japanese yen. 758.38. See, 758.39. That's where we made a mistake. Okay. So there is a rounding of difference from the beginning. I will tell you. 7 lakh into 79.09 divided by 0.73 comes to 758. 39,726. So if you will just use this $7 lakh with this rate now directly, the answer will be 758.39,726. But what has happened? The answer of this has been rounded off to 2 decimals, 0.34, right? 0.34 instead of 4 decimals, and that's why the answer started varying from this point, 38,000, 39,000. You can do your own calculation and you will get to know. And because of that, it is 50, 55, 87, 50, 55, 98. That's okay. But the final value got changed. 76343 76345 5315 961 929. 76345 divided by 79.1950 964017. See, all in all, everything is a rounding of difference now. You can do the calculation, cross check 10 times. All the exchange rates that we have taken are correct as per the institute, but since they have converted it in from direct to indirect, I told you, whenever you do this kind of a practice, like whenever you convert from direct to indirect, there are chances that you will end up making a mistake of rounding off, and that's what is happening here. They have taken only 2 decimals, 79.09 divided by 0.73. Yeah, they should have taken 2 more decimals, which comes to 25, and the answer will change. Since there are 4 decimals, now here you can clearly see there are 4 decimals, so here as well 4 should be taken, and in this case also you have rounded off to 0.0126, and that made all the difference. The actual, if you will calculate, it will come to 28,264. So both the answers are correct in a sense. 28,264. The difference is because of the rounding off. So out of the 3 options, the profit is in the case of investment is made in New York, because in all the other cases we are going through loss. So we are not going to invest the surplus funds in Sydney and Tokyo. We are going to invest that in New York itself. We will invest the US dollar in New York. After receiving the investment proceed, first thing that we are going to do in New York itself is make the repayment of the borrowing 7,07,000 and bring the balance gain to our country, and that will be the total profit, net profit. So in the same manner, we have to do this question number 50, London, New York and Frankfurt. Okay, London, New York and Frankfurt. This is pound, this is US dollar, and this is euro. Instead of Japanese yen, this is euro. You have been given with these rates. You can see that all these rates are going up, swap points are going up. You will add it, but in the second part you need to be very careful. London to Frankfurt, this is declining rates, so you have to deduct these swap points in order to arrive at forward rates. And all 1 month, 2 month, 3 months, all of them are not required, just one. I think, let me check. See, for a period of 3 months. So this is only important. Forget about the 1 month and 2 month swap points. And in this case also, this is only important. At which center will the investment be made? So we will calculate the investment in London, New York and Frankfurt. You can see there is a profit of 1662. See, you are from London in this question. So make sure that the ultimate profit or loss should be calculated in the London's currency, which is pound, not any other currency. Arbitrage profit in this case is this much, in this case is 3231, and in this case is 2047. In all the three cases there is a profit. As compared to the previous question, there was a loss in the two cases, but in this case there is a profit. Okay, what you can do is highest profit party should be chosen, or place should be chosen, which is again New York in this question. Okay sir, if you want to understand the question, this is the best way to understand which currency you are selling, which one you are buying, and at what time. So this is all about spot rate, and this is all about the other one. This is all about the forward rate. So this is the best way to solve the question if you are unable to understand what mess has been done in the format. But in exam, obviously you will have to write it like this only. You can also see that in this question we have some common 327,285, 327,285. This is the dollar that we have to pay, and for that purpose we will have to buy the dollars by paying this much of the pound, where it was 992 in the previous question. Okay sir, coming over to question number 51. Let's have a look.